Thanks for clicking. Canada's real estate prices are going to undergo a 24% plunge, according to a new report by Oxford Economics. So just like Canada has undergone an unprecedented rise in the price of its housing over the past few years, Oxford argues that it will also go through an unparalleled correction over the next few years as well.
Took you long enough.
Yeah, with Canadian house prices up over 20% from this time last year, a large-scale real estate correction is definitely on the minds of many Canadians. So what I want to do today is go over the 3 triggers of this 24% real estate plunge as predicted by Oxford Economics. Then I want to go over a few recently released reports which shows that Oxford Economics might just be onto something as we're seeing more and more signs of a slowdown in Canada. We haven't hit a crash yet, we haven't hit a correction yet, but the signs are growing that this correction, this reversal of a real estate market is coming. If real estate does slow down or have a big correction, it won't be instantaneous. It won't be like we wake up tomorrow and house prices are 10% less. It just doesn't happen that way. It will be a slower development. It will be caused by an increase in supply, a decrease in demand, which we're about to get to, or absent some external shock. Like we've never said that before. But absent some external shock, this will be a slow process as real estate corrects itself from the meteoric rise that we've seen over the past few years. So we will have updates on this correction as it unfolds, if it unfolds, but as it unfolds, we will have those updates on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this report. So, as mentioned, Oxford Economics argues that there will be 3 main triggers of a reversal in Canada's real estate prices. First and foremost, Oxford argues that the price of Canadian real estate has just gone way far beyond the carrying capacity of the average Canadian. In that by late 2021, home prices were 19% beyond the borrowing capacity of median income households in Canada. The report then argues that should these trends continue, prices will hit 38% over and above Canadians' median affordability. The report says that they believe this will cause the housing market to reach a breaking point and crash under the weight of its own success before year end. So with higher borrowing costs, which we're about to discuss, and prices going up and up and up, the report argues that many buyers will just exit the market. Many buyers will decide that this is just too expensive for them. Either the buyers will decide or the interest rates will decide. One way or another, it will be decided that the price of Canadian real estate is just too far above the affordability of Canadians.
I can't take it anymore.
And as a result, prices will go down. As buyers exit the market, we will have more and more of a glut of supply, as nobody will be able to afford these high prices. And as a result, the sellers of Canadian real estate will have to lower their prices in order to attract those buyers back into the market.
Come back. Come back.
Second, the report argues that higher borrowing costs, with the Bank of Canada already raising rates by 25 basis points, in this report predicting that we're likely to see 75 more basis points hikes by the end of the year, these higher borrowing costs will push people out of the market as well. The report then says that we're going to have a slowdown in 2023 as per rate hikes, but then we'll see a few more in 2024. And as a result, we're likely to see fixed mortgage rates hit 4.25% by the end of 2022. I mean, we're going to talk about this at the end, but with buyers for the last few years only having to qualify at either 2 points above the contract rate or 5.25%, most buyers qualified at 5.25%. But if that rate does get up to 4.25%, 4.5% of the contract rate, not only will that affect mortgage payments, and people will take themselves out of the market not wanting to have those mortgage payments, but it will also affect how much people can actually afford at the lender level, as people will have to qualify based on will have to qualify based off 6.25%, 6.5%, rather than that 5.25%. So home buyers are going to be affected on both ends.
You're getting one way or the other.
Both on the lender's end and on their own pocketbook end, in their own wallets. So the report argues that as real estate values go up, while simultaneously interest rates are going up, something will have to give. And third and finally, the report argues that these government policies set to come down, we're probably going to see some, and that in that annual budget coming released in April, that these policies will help to cool the market, help to contribute to that 24% plunge even more. So according to the report, government policies such as a house flipping tax, temporary ban on foreign ownership, and a tax on non-resident owned vacant homes will further help dampen demand for Canadian real estate. I'm not sure if the writers took into account that Trudeau recently voted down his promised ban on foreign ownership. Trudeau had promised this ban on foreign ownership during the 2021 election campaign, and then, to very little fanfare, reversed course a few weeks ago. So it's not clear that they did take this into account, but nonetheless, we're still expecting to see major changes to the Canadian real estate market coming down in April. As we discussed, we might see the ban on blind bidding, a tax on house flippers. We could see higher down payments for real estate investors. So all in all, these are also likely to contribute to cool down our market in the 24% range as outlined by Oxford Economics. So, according to this report, with the market overheating itself, putting itself far above the affordability of the median household in Canada, with the rise in interest rates, and with government intervention, we're likely to see a 24% plunge in house prices. The report does note that were none of these conditions to be present, were interest rates to remain low and were the government to stay out of it, we would probably be looking at a 40% market crash. That seems a little arbitrary to me to go between 24% and 40%. One's a plunge, one's a crash, but I didn't write the report, but that's what they say. So they're saying that as rates go up and as prices get too high, the affordability gap becomes too great. And as the government intervenes, we're likely to see this 24% plunge. And I definitely think that there is some evidence of that. RBC recently released another report saying that attitudes towards home buying intentions in Quebec have receded to the same amount that they were pre-pandemic. So during the pandemic, we saw a lot more people wanting to get into the market. That has receded in the past few weeks, at least in Quebec. We also saw that the mortgage rates have gone up quite a bit in the past few weeks, with RBC's rate actually being 3.49. So now, for the first time in the last few years, you do actually have to qualify at the higher end of the stress test. With a contract rate of 3.49%, 2% higher than that, now you're qualifying at 5.49% rather than the 5.25% that you've had to qualify for at least the past few years. So it's only 0.24%, but it's definitely, we've only had a 25 basis point rate hike from the Bank of Canada. So rates are going up. Mortgage qualification standards are going up. We are seeing a receding of people trying to get into the market. And although we don't have any data yet for March from the real estate agents that I've spoken to, from a lot of the buyers that I've spoken to, and from just looking on MLS, there's a glut of houses coming onto the market. And I think that we're going to see, when we look at the data in April, the March data, we're going to see that there was a lot more supply out there, and I would assume we're going to start to see that the over-asking has started to calm down a little bit. I think we're definitely going to see that in my hometown of London, Ontario. But I think the signs out there that we are starting to at least see the beginning of this market correction, of this plunge in real estate prices. And there's definitely signs that this report does have some merit. So as we see more signs out there, as we start to get more data in, we'll definitely have updates on this channel. If you want to get those updates, click like and subscribe, and thanks so much for watching.